And during bear markets, that ratio goes up. The people that have been buying coins in the bear market that have gone through a lot of that, they're generally not going to sell anytime soon, even with a significant bull run. It would take a very high price point to get those coins out of their hands. On the other hand, when you have bull markets, you have a lot of new buyers coming in. Generally, that's the handful of times when those longer term holders tend to sell. They sell into that strength. We've not really seen that cycle start yet. And so I still think we're fairly early phase in the bull market.
Hey guys, welcome back to Everyday Finance. In this video, Lyn Alden discuss about Bitcoin. According to Lyn Alden, those who have been purchasing coins during the bear market have experienced significant challenges and are unlikely to sell anytime soon. Getting those coins out of their hands would require a steep price. On the other hand, during bull markets, there are many new buyers entering the market, which usually happens only a few times in the long run. Holders typically sell when the market is strong. But we have not observed that pattern yet. Lyn Alden discusses this cycle. She believes we are still in the early stages of the bull market, but that doesn't necessarily indicate anything about the next 3 months based on Lyn research. It appears that the price of Bitcoin is largely influenced by market trends over a 6-month period, typically associated with liquidity over a few months. What are some of the liquidity measures they can turn to, and how severe would they allow it to become? Before being forced to intervene, factors like liquidity can influence Bitcoin's behavior. Over the past few quarters, there has been a positive trend, and looking ahead to the next 2 years and beyond, Lyn Alden is very bullish, and lots of things Lyn Alden discuss, so please watch the video to end, and share this video and subscribe our channel, Everyday Finance. Thanks.
We've already hit some of the targets. I have a very big range for what I expected to go to. I've been trying to stick to like a 2-year view because I don't really know for sure what's going to happen in 2024. I have higher conviction that throughout the course of 2024 and 2025, it'll be notably higher than it is now. That's kind of my overall base case. I'd be surprised if we didn't see 6 figures in that 2-year view. Certainly possible that we won't, but I'd be surprised if we would not. And from there's a very big range because you'd be trying to predict what do humans do when the price goes up. Well, how much of them will buy, I don't know. But basically, we know the supply side. We can also look at on-chain indicators to see, for example, the behaviors on the supply side. So you can look at how many coins are held by entities that have a very low propensity to sell. And during bear markets, that ratio goes up. The people that have been buying coins in the bear market that have gone through a lot of that, they're generally not going to sell anytime soon, even with a significant bull run. It would take a very high price point to get those coins out of their hands. On the other hand, when you have bull markets, you have a lot of new buyers coming in. Generally, that's the handful of times when those longer term holders tend to sell. They sell into that strength. We've not really seen that cycle start yet. And so I still think we're fairly early phase in the bull market. But that doesn't mean anything about 3 months or 6 months. Generally, my research shows that Bitcoin price is heavily correlated with liquidity in any given multi-month period, generally speaking. And so kind of the stuff we talked about earlier in the conversation, what happens when the reverse repo facility gets low? What are some of the liquidity actions that they can resort to? How bad would they let liquidity get before they were forced to intervene? Those types of things can all determine what Bitcoin does in any sort of given quarter or couple quarters. But long term, next 2 years and longer, I'm quite bullish. Not that much because, so for example, Bitcoin has a difficulty adjustment associated with it. So for example, if energy costs spike and the price of Bitcoin does not, then the weakest miners go bankrupt or stop mining. And then the network checks every 2 weeks what is the average rate of block production, which depends on how many miners are on the network. And then if miners have fallen off the network, then it makes block production easier. It basically calibrates to the number of miners that are currently on. And so energy, it's in and of itself does not really directly impact miners. The indirect thing is that governments can use that as a narrative, because governments don't particularly like the fact that things like Bitcoin exist. And so if you get energy price spikes, then you get things like, governments blaming Bitcoin for it, or trying to say we have to push Bitcoin out of our jurisdiction. And so it really can kind of move around where the Bitcoin miners are.
According to Lyn Alden, Bitcoin experiences challenges with its adjustment process. For instance, if energy costs increase while the price of Bitcoin remains stable, this can lead to when miners with the least amount of resources go out of business or cease their operations. The network undergoes a verification process every 2 weeks. The average rate of block production is determined by the number of miners on the network, if there are more miners. If some miners drop off the network, block production becomes easier as it adjusts to the number of miners. Currently active energy does not directly impact miners, but governments play an indirect role you can utilize that as a narrative, since governments are not fond of the existence of things like Bitcoin, especially when there are energy price spikes. Then there are instances where the government is pointing fingers at Bitcoin and suggesting that it should be removed from our jurisdiction. Let's back to the Lyn Alden interview.
To determine kind of how difficult it is to operate a mining business, but for the most part, it doesn't really affect the blockchains themselves, because that's been taken into account by the design. In fact, that's arguably Satoshi's main addition, because when you put Bitcoin together, there are a bunch of things that already existed. He didn't invent blockchains. He did not invent proof of work. He didn't invent the types of encryptions that he used, but he put it all together, and then he added the automatic difficulty adjustment, which is kind of the control mechanism, the automatic control mechanism that makes it work. Because if you tie money creation to processing power, then as processing power increases exponentially, it would eventually inflate the currency. It would result in quicker block time generation than expected, and therefore more coin issuance than expected. And so having that difficulty adjustment in there makes it so that even as processing power keeps increasing, it does not result in faster block times. And even as you get, say, higher or lower energy prices, the network adjusts for that as well. I think that's a reasonable time frame. It depends on a number of factors. So the Treasury general account is no longer increasing, so that's not really sucking any liquidity out of the system. And so overall, I think you still have another quarter or two, or potentially longer, of reverse repos. And then we'll see, does the Fed, I guess the main choice is to see if the Fed kind of preemptively adjusts to that, or if they wait until there's a liquidity event and then jumps into it. So if there's a liquidity event, you can certainly see a down move in any sort of high volatility assets. But I'd probably be a buyer of those types of dips for assets that I like. It's a big fork in the road. I think that, CBDCs are basically the capstone on the multiple centuries of centralization that I just talked about, right? So that's the final thing. That's basically that the government can monitor every transaction that happens, freeze any transaction they don't like. That's kind of the end state from the centralization perspective. On the other hand, we have, for the first time in history, we have ways to do distributed settlement, ledgers that are backed up by energy in a decentralized manner rather than just tied to like one central bank's ledger. And so we kind of, for the first time, have the ability to do speed without centralization. Whereas for centuries, almost every friction in money is solved by centralization. You say, okay, we'll just make this friction go away by centralizing it. We'll just use the shared ledger. And then when that has frictions between like another shared ledger, we say, okay, we'll build a bigger ledger under them. We'll make it a central bank. And when central banks have trouble, kind of connecting with each other, they resort to connecting it into an even bigger central bank. So the world reserve currency, it used to be Britain, now it's the United States. Almost every problem is solved by centralization. But with this technology, as long as humanity has the internet and other high bandwidth manners of communication, which they've had for a long time now, there's ways to do this in a more distributed manner. And so I think that technology is going to be very powerful. And we've kind of seen interesting scenarios where, for example, in Nigeria, they have ongoing long-term currency crisis, high inflation, persistently high inflation. And so they had, they also have a fairly tech-savvy population, especially in cities there. And so you had very high adoption of things like Bitcoin and stablecoins. And so the central bank said, well, okay, we're going to block all banks from sending money to crypto exchanges to try to slow this down. And we're going to introduce a CBDC. And what happened was that ban was in place for something like 3 years. Nigeria, by most metrics, for example, Chain Analysis estimated that they had the second highest crypto adoption in the world, and specifically the highest peer-to-peer trading volumes in the world, because that's how they went around those bank blockages. So they failed to slow down, Bitcoin, stablecoin, and sometimes other crypto use cases or speculation. At the same time, their CBDC had very low and slow adoption. No one really wanted it. It wasn't really solving a problem that people wanted. And in recent months, the central bank has actually reversed their prior ban. It's kind of acknowledging that it was not working, and instead they're saying, well, let's instead try to regulate this because it's not working. And I think that's kind of a theme we're going to see a while, is that, central bank digital currencies, they don't really solve a lot of problems that people are looking to solve. And so I think we're probably going to see an ongoing battle between what policymakers want to happen and what the people find actually kind of serves their needs better.
According to Lyn Alden, the impact on blockchains is minimal, as it has already been considered in the design, which is a key aspect of Satoshi's work. In essence, Bitcoin is a combination of existing elements. The creator did not invent blockchains or proof of work. He didn't create the types of encryptions he used, but he assembled them and made additions. It's the automatic difficulty adjustment that acts as the control mechanism, ensuring everything runs smoothly when dealing with finances from creation to processing power. As processing power increases exponentially, it will eventually lead to the inflation of the currency. The block time generation is faster than anticipated, leading to a higher coin issuance than initially projected. With the challenging adjustment included, it ensures that processing power continues to improve. Increasing, it does not lead to quicker block times. And as you continue to speak, when energy prices fluctuate, the network automatically adjusts accordingly. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance. And we will meet in next video. Thanks.